journey and you're theirs too. I swim with tea when they turned in. The staring out to mute and can lend a pole that some kid died.
One of the most important shareholder loan rules in Canadian tax law is the repayment timing rule. Many people assume that as soon as a shareholder borrows money from a corporation, the amount immediately becomes taxable. In reality, the rules are more nuanced than that. A shareholder loan can often avoid immediate taxation if it is repaid within a specific period established by the Income Tax Act. This is why timing becomes critically important. Let's walk through the timeline shown on this slide. Imagine that a shareholder loan arises during the corporation's 2025 taxation year. The corporation then completes its 2025 year-end on December 31st, 2025. The next corporate taxation year runs throughout 2026 and ends on December 31st, 2026. Under the shareholder loan rules, the shareholder generally has until 1 year after the end of that following taxation year to repay the loan. In our example, that means the repayment deadline would be December 31st, 2027. Notice how this creates a much longer repayment window than many people expect. The key principle is that the shareholder loan does not necessarily have to be repaid immediately. However, it must be repaid before the statutory deadline if the taxpayer wants to avoid the potential shareholder loan income inclusion rules. This is why accountants carefully monitor shareholder loan balances and keep track of the dates when those balances originated. A shareholder who plans ahead may be able to repay the balance, clear the loan account, and avoid adverse tax consequences. On the other hand, a shareholder who ignores the balance and misses the deadline may face a completely different tax result. For this reason, accountants often maintain detailed schedules showing when shareholder loans were created, how much remains outstanding, and when the repayment deadline will occur. The most important takeaway from this slide is that timing matters. When dealing with shareholder loans, the tax outcome is often determined not only by the amount borrowed, but also by whether the loan is repaid within the required period. Understanding this timeline is the foundation for everything that follows in the shareholder loan rules. Now let's look at what happens when a shareholder loan is repaid within the required time period. This is the outcome that accountants and tax advisors are usually hoping to achieve. Imagine that a shareholder borrowed $85,000 from the corporation. At first glance, that might seem concerning because shareholder loans can potentially become taxable under the Income Tax Act. However, the shareholder loan rules contain an important exception. If the loan is genuinely repaid within the permitted period, the shareholder may avoid having the loan included in income. Let's follow the process shown on this slide. The loan is created when the shareholder receives funds from the corporation. At some point before the repayment deadline, the shareholder returns the money to the corporation. This repayment reduces the shareholder loan account balance. Once the repayment has been recorded, the shareholder loan balance may be reduced to zero. If the repayment satisfies the requirements of the Income Tax Act, the shareholder loan inclusion rules generally do not apply. In other words, the loan remains a loan and does not become taxable income. This is why accountants carefully monitor repayment dates and maintain detailed records showing when loans were created and when they were repaid. From the corporation's perspective, receiving the repayment restores the funds that were previously advanced to the shareholder. From the shareholder's perspective, the repayment can prevent a potentially significant tax problem. As a result, the overall outcome is usually much cleaner and simpler. The shareholder loan account is cleared. The repayment requirement has been satisfied. The CRA rules have been respected. And most importantly, the shareholder avoids having the outstanding loan balance included in personal income under the shareholder loan provisions. Of course, The repayment must be genuine. The money must actually be returned to the corporation, and the transaction must be properly documented. Assuming those requirements are met, a timely repayment can be one of the most effective ways to avoid adverse shareholder loan tax consequences. The key takeaway is simple. A shareholder loan does not automatically become taxable when the loan is genuinely repaid within the permitted period. The shareholder can often avoid the income inclusion rules altogether, resulting in a much more favorable tax outcome. Now let's examine the situation that creates the greatest concern for both accountants and the CRA. When a shareholder loan is not repaid on time. As we learned in the previous slide, a shareholder can often avoid an income inclusion if the loan is genuinely repaid within the permitted period. But what happens if that repayment never occurs? Let's begin with a simple example. A shareholder receives $85,000 from the corporation and the amount is recorded as a shareholder loan. Time passes, but no repayment is made. Eventually, the repayment deadline arrives and the loan is still outstanding. At that point, the shareholder loan rules may apply, and the outstanding balance can be included in the shareholder's taxable income. In other words, the CRA may treat the amount as income even though it was originally recorded as a loan. This can create a significant and unexpected tax liability for the shareholder. However, the CRA is concerned about more than just unpaid loans. The CRA is also concerned about arrangements designed to create the appearance of repayment without actually reducing the shareholder's access to the money. This practice is commonly referred to as loan cycling. Consider the example shown on the right side of the slide. The shareholder repays the loan shortly before the deadline. The corporation receives the money, but immediately afterward, the corporation advances substantially the same funds back to the shareholder. Economically, nothing has really changed. The shareholder still has access to the money, and the corporation is effectively in the same position as before. Because of this, the CRA may challenge the repayment. The CRA will often examine the timing of transactions, the source of the repayment funds, the shareholder's borrowing patterns, and the overall substance of the arrangement. If the repayment appears to be temporary or artificial, the CRA may conclude that the loan was never genuinely repaid. This is why documentation and substance are so important. A genuine repayment usually has several characteristics. The money is actually returned to the corporation. The loan remains repaid. The shareholder does not immediately borrow the same funds again. And the overall facts demonstrate that the repayment was real and permanent. By contrast, loan cycling often involves short-term repayments, immediate reborrowing, repeated patterns of similar transactions, and a continuing shareholder balance that never truly disappears. Those situations are much more likely to attract CRA scrutiny. The key takeaway is that the repayment must be genuine. Simply moving money back and forth to satisfy a deadline is not enough. If the repayment lacks substance, the CRA may ignore it and apply the shareholder loan income inclusion rules anyway. For tax professionals, this means that timing matters, but substance matters even more. A properly documented and genuinely repaid loan can avoid significant tax consequences. A temporary repayment followed by immediate reborrowing may not.